In light of the recent run-ups and subsequent crashes of GameStop and AMC, I thought it would be the perfect time to revisit the classic tale of the greater fool. Hey everyone, welcome back to the channel. My name is CJ and I'm a software engineer and investor in Chicago. And today I want to talk about the greater fool theory. We'll talk about what the greater fool theory is, what are the consequences of it, and how we can avoid being the greater fool in the future. Before we begin, please subscribe to the channel if you find this video useful and want to stay up to date with the rest of the videos that I release. And as a reminder, this is not financial advice. Also, there will be timestamps in the video description below if you want to skip around to any point in this video. All right, with all that said, let's get into it. So what is the greater fool theory? The greater fool theory is the underpinning of any speculative bubble. It states that a market participant will buy an asset regardless of price or value if they expect that they can sell it to someone else, aka the greater fool, at a higher price at some point in the future. We saw it in the 1600s with tulip mania in the Netherlands, and we're seeing it again today rebranded for the times as meme stocks rise and fall. Is there any other reason besides a total misunderstanding of the asset that someone would buy something so blatantly overpriced, if not to just pawn it off onto the next buyer? Let's take GameStop for example. Buying GameStop at $5 per share was a pretty reasonable value investing bet based on the disconnect between the fundamentals of the business and the over-pessimistic undervaluation of GameStop's market position. Unless you have no idea what's going on, buying GameStop at $100, $200, or $300 can only be explained by the greater fool theory. Nobody buying at those inflated prices truly believed that GameStop was actually worth $22 billion, when the business was only being valued in the market at $2 billion just a few weeks before. One might argue that this time it's different because there's a movement to stick it to all the hedge funds. But for every hedge fund ruined by Wall Street bets for taking a short position in GameStop, there will be hundreds, if not thousands, of individual retail investors who will lose money by buying at or near the top, and sometimes this is more money than they can afford to lose. Okay, so now that we have a better understanding of what the greater fool theory is, let's discuss some of the consequences of participating. Let's face it, we all have fantasies of being the next roaring kitty, making millions and millions of dollars off of a single bet within just a few short weeks. It's perfectly understandable. Humans are always seeking a get-rich-quick scheme. But this mania of rapidly rising stocks fuels a cycle of euphoric speculation until someone is left at the top of the bubble holding a bag of extremely overpriced assets. It's hard to watch other people's portfolios skyrocket as you sit on the sidelines, sitting on your hands and thinking you're being wise. But seeing the price of something rise rapidly is not a reason to put your money at work. It's actually a great way to lose money rapidly if you're into that sort of thing. As a side note, it's probably not a good idea to take out a second mortgage on your home to finance your speculation. For me, the main downside of participating in the greater fool theory is pretty straightforward and simple. There's just too great a chance of you permanently losing your money. There are just way too many unknowns out of your control completely. Again, let's look at the GameStop example. GameStop seemed to be rising and rising and rising, making millions of dollars for plenty of investors. And then suddenly, Robinhood has a liquidity crisis. The ability to buy shares in GameStop and AMC and other meme stocks dried up instantly, completely popping the bubble and ruining any momentum that the stock had of continuing upwards and upwards. Another huge downside is you need to be super active as you try to avoid being the greater fool, which in turn makes you a fool yourself. Markets are a mechanism to move money from the active to the patient. You spend all of your time consumed checking the stock prices fluctuating on a second-to-second basis. I personally just couldn't sleep while holding on to something like this. Real investing shouldn't require you to look at your portfolio even monthly, let alone on a second-to-second basis. If you've been following GameStop or AMC for the past few weeks, you've probably spent your time glued to your screens just checking the price second after second. It's just not a productive or sustainable way for me to spend my time or try to make a living, so I'm just going to avoid it at all costs in the future. Let's face it, we're human, and markets are fundamentally driven by bouts of fear and greed. There's no way to escape that. I'm not immune, you're not immune. In the past, I have put small amounts of money into speculative asymmetrical ventures, which I thought were actually investments, and let's just say that it didn't work out. I thought I was investing and it turned out to be a speculation, and even though the loss was pretty small, any loss hurts, regardless of the size. It's part of the growing pains of learning what an investment truly is. Part of the reason I'm making this video is to publicly reinforce the fact that speculation is not my game. It is not my area of strength. So I'm putting together a plan to avoid being the greater fool in the future. I'm only immune to the extent that I've built a good system to keep me rational. There's an old quote often attributed to Mark Twain that goes something like, "If a cat sits on a hot stove, he will never sit on a hot stove again. He will also never sit on a cold stove again either." Lest we become the cat that never sits on a stove, whether it's hot or cold, let's figure out how we can deal with the consequences of being the greater fool without killing our appetite for investing permanently. Of course, it's not a crime or immoral to speculate, but it's very important to realize that even if you think there's the slightest hint that you might be speculating, there's a pretty big chance that you could end up being the greater fool. So how do we combat the urge to participate as the greater fool in the future? I know this may sound kind of cheesy, but I would ask the question, what would Warren Buffett do? For instance, would Uncle Warren be putting his hard-earned money into this, or would he see the headline in the Wall Street Journal and kick his feet back up on his desk and continue to read annual reports? Next up, don't buy or sell anything while the market is open. And don't often look at your portfolio either. I'm talking maybe once a week at most. This is something that I learned from Monish Pabrai. He'll never place an order for a stock when the market is open. The pressure is just too great. You see the stock price fluctuating from second to second, and you'll probably make an irrational decision based on the emotion of seeing the price ticking up or down. It's all consuming, and you just can't take your eyes off the stock chart. So let's remove the temptation from the get-go. Next up, simply understand that probably by the time you hear of something, especially if an opportunity sounds like a get-rich-quick scheme, chances are that the smart money has already taken their profits and they're handing the money bag over to you to hold when the bubble bursts. For example, hedge funds made $700 million in the recent run-up of GameStop stock. Contrast that with people putting half of their life savings or taking out a second mortgage to put it into GameStop stock, only to see that sum halve in a few days, and it's not pretty. There's this common saying that I really hate, which is, don't invest more than you're willing to lose. First of all, the saying should be, don't gamble more money than you're willing to lose. But if that thought does cross your mind, you're almost certainly speculating, and you should probably just get a bag of popcorn and watch from the sidelines and enjoy the entertainment. Maybe at the end of the day, if you've been a participant in a bubble, or you have been the greater fool, maybe you don't need any extra reminder at all. If you want to learn more about the difference between investing and speculation, I'd suggest you check out this video over here. I also cover the GameStop short squeeze situation in more depth over here. If you're interested in learning more about the history of speculative bubbles, read the book The Devil Take the Hindmost. It's a really eye-opening book about how common and destructive market bubbles can be. I appreciate you all for watching this to the very end. Thank you very much, and I will see you next time.